So significant growth here from PayPal and their revenue. That's all we need to see. That's great. Hey everyone, so it's been a long time since I looked at PayPal, and since the price has fallen from above $300 to I think $110, which is like a 60% fall in 6 months. Wait, 60% in 6 months? That's brutal. I had to actually do a double take when I saw this. Anyway, it just goes to show you how volatile things can be sometimes. Anyway, it's a great time to take a look at PayPal and have a read as to why it has fallen the 60% in such a short period and see whether that is justified or not. All right, paiehoe. Also, I do apologize about the sound. I'm in a new setup here in an apartment in Paris, and the system isn't very good here, but hopefully you can bear with me. Anyway, so after taking a look at the earnings report, this is what I see. Revenue for PayPal is up 13% year on year, and earnings per share was up only 4% year on year, which I guess wasn't very exciting for the analysts. So my first impression is that even after a big 2020, where everyone had to buy stuff online, for that to be far less intense in 2021 and the business still grew from these pandemic levels, well, that sounds pretty good to me so far. So I think the issue is that PayPal had originally said that they were aiming for this 750 million active accounts by 2025, but now they said that's unlikely. And when a company misses goals like this, it does throw out some people's valuations. So I can actually understand the price fall. Now, management did say they want to double down on Venmo and better super app services to widen their moat. That was their words. Now, being from outside of America, I actually had no idea what Venmo even was, but Andrew Latenda, my friend and fellow YouTuber, has told me about how everyone sends money to each other with Venmo. He even said it as a verb, like just Venmo me that money after meeting at a restaurant. So this is cool, and I think it's a great part of their business. And to back that up, over the past 2 years, Venmo has seen significant growth from 10 million to 40 million users. And in that time, it doubled revenue and tripled their annual payment volume. But the issue is still the 2025 user target number of 750 million. That's probably not going to happen, and management feels like it's not going to happen. 750 million users would have translated to about $50 billion in revenue by 2025. So with this information, we can calculate some scenarios based on the lower revenue numbers. But before I get into this, PayPal does have competition. Square, Zelle, Visa, MasterCard, there are lots of options for making payments. I find it a little hard to get a read on this space, but I think there is room for all of them. I don't think it is a winner-take-most situation, but I could easily be wrong here too. Now, before I get into the valuation, let's quickly check the other areas that we should look at before we get too far ahead of ourselves. One of the first things I look for is revenue growth over the last sort of 5 to 10 years. And as you can see here with PayPal, if we go back from 2012, it was about 5.6 billion. Now it's up to 25 billion. So significant growth here from PayPal and their revenue. That's all we need to see. That's great. Now turning to gross margins, and gross margins are important because if the gross margins are declining, it means that competition's eating away at their moat. So, and that's exactly what we're seeing here with PayPal. It was in the mid 60s back 10 years ago, and now it's in the mid 50s. So it is slightly declining, still very healthy, but we're going to have to get it across here because it does mean that there is some competition issues, and this is how you see that. Okay, the next thing I'm looking at is return on invested capital. For PayPal, it's never been super strong. We're at the moment around about the 15% mark. We're going to give that a tick because that's actually pretty good, but some companies like MasterCard, even Visa, those companies, they have significantly higher return on invested capital numbers. This is okay. It's not fantastic. It's good enough. Okay, now we go look at their debt situation. And to do that, I'm in TIKR Terminal, and there's a link for TIKR in the description if you're interested yourself. I actually pay an annual membership for this data. The US company data is free, but international companies you do have to pay for, and I have a lot of international stocks in my portfolio, so yeah, I need that. Okay, now to just quickly look at their debt levels, I'm looking at total current assets, and I can see that's 52 billion. And I'm going to compare that to the total current liabilities, which is here of 43 billion. So when the current assets are significantly above the current liabilities, that means they're in pretty good standing for the short term, and that's enough for now. When I dive deep into this company, I would look at their longer term debt, but that's fine. Now I'm back in Morningstar and I'm looking at the free cash flow growth here. And back 10 years ago, it was $1 billion. Now it's 5.5 billion. That's great. Let's move on. Now, while we're here, I can actually look at the shares outstanding as well. We want to see this number going down, and it was 1.2. Now it's 1.186. So it has very slightly gone down. That's great. We can give that a tick as well. That's what we want to see. Now for insider ownership, I go to Simply Wall Street and I have a look at the leadership team section here on the screen. And I want to see the top couple of people in the management team with significant ownership stakes compared to their compensation. So we're going to have to give this a cross because the Daniel Schulman, the president, John Rainey, the CFO, they only own, well, only, when I say only, it's still $20 million worth of shares, but their compensation is $23 million. So they're going to get paid more than their ownership in the company. Normally, I'd like to see their ownership 10 times as much as their compensation. So unfortunately, insider ownership, we're going to have to give it a cross. Now, another thing I like to look for are what super investors have invested in this company. That would give me more conviction. And I'm over in Dataroma, and I can see that we've got, well, Pat Dorsey, Terry Smith, they're people that I'm familiar with, and I think are fantastic investors, and they have large percentages of their portfolio in PayPal. So that's a tick of approval as well. Okay, now for the valuation. Let's say that the relationship from revenue to free cash flow stays around about the same as it has done in the past. Actually, let's reduce it a little to be conservative. So 50 billion in revenue is out of the picture now, according to management. But at 25 billion right now, let's say they don't even get to 40 billion in revenue. Now, I think that is fair enough, and that would be about 10% per annum from here. So let's give them 10% as a growth rate, and I feel pretty comfortable with that. And then let's even reduce it to 8% after that, as who knows what's going to happen with the competition in the space. Now, when you're doing this yourself, remember, they have been growing at like 20% for a decade now. So I feel like this is nice and conservative. And I'm also not factoring in the share reduction as well. So then that is a few percent, and that's just to help us along the way. So using my intrinsic value calculator, which is free, you can get it in the description. What I've done is I've gone ahead and put in the free cash flow, the shares outstanding, the cash, the debt, what those growth rates that I just said were, a fair multiple, and my discount rate, what I think is, well, 22% is where I'd start getting interested in the price. And it tells me about $50 for PayPal would be where I'd be getting interested with those very conservative growth rate numbers. But let's be even more aggressive and chase a bigger discount rate, the discount rate that I would be looking for in my investments, and that's 30%. I know that's massive, but that's what I look for. That means I really wouldn't be buying this until around $31. So still a long way to go before PayPal gets down to $31. Now let's play around a little bit more here and improve those growth rates up to a little bit. Let's give them a little bit more credit for being such a good company that they have been for a long time now, and Venmo growing really quickly and things like that. So we'll give those growth rates 13% and 10%. And I'll increase the multiple slightly as well because, you know, better growth rates should give you a better multiple. And we're talking now about $60 a share. That's where I'd be getting pretty interested. Now let's be less conservative again and put the growth rate up for from years 5 to 10 up to 15%. It's been a good company. It's been growing at 20% or so. So getting to 15% doesn't seem like too much of a stretch. And it's telling me now about $70 a share would be where I'd be getting interested. That's still only my 22% discount rate, not the 30% that I really chase. So what all this tells me is that at $300, there was not much margin of safety at that price. And with the slowing down and missing on future projections, the share price has fallen to a level that is probably more reasonable anyway. 300 seems well above fair value. Now, I was being probably over conservative with my valuation, I know that, but I like it around that $60 mark. That would feel pretty good for a company that will grow with the online world. It's not like that overall trend is going away anytime soon, but I really want a margin of safety, and I think at $60, I'm getting a good deal on a good company. And in the comments, I don't really care if you think I'm being ridiculous with my assumptions, because I'm just doing what I feel is right for me and my money. You can be more aggressive and bullish on the company than me. You probably know a lot more about it than me as well. I didn't even know what Venmo was until about 2 months ago. So each month I will update my watch list and provide market commentary in my e-magazine that I will write myself. A new edition is coming out the first Wednesday of each month. You can take a look at the February edition to get a feel for what the e-magazine is, and it's free and it's in the link in the description. And I want to say a big thank you before I go to Dylan Jacobs. I'm glad you liked my beard when I was in Georgia. Sorry, I'm trying to regrow it a little bit now, but I've had to shave it down. It was getting too itchy and getting food in it. Anyway, I appreciate the support. You're a legend. Thanks for being here, and I will see you all in the next video.